Hi everyone, and welcome to this month's edition of The Mortgage Mentor and Other Stuff by Paul Carman. Today I'm going to be talking to you a little bit about rates. We're going to talk about rates because it tends to be something that's very overlooked, very misunderstood. I shouldn't say overlooked, it's not overlooked. It's something that is very misunderstood when it comes to mortgages. Rates are the one thing that the consumer can zero in on and say, this is something that's objective, this is something that I can relate to. As such, it's very powerful, but you need to understand that when you're working with a mortgage broker, rates is only one part of the equation. We can help you save interest on a whole lot more than just according to the one rate that you've got. So, to begin, let's take a little bit of a look at definition. When we're looking at mortgages, there's only really two basic types of animals. There's two species, as it were, in mortgages. The one is the fixed rate, the other is the variable rate. I'm a visual guy, I like visual, so let's have a demonstration. This water bottle is a bit like a fixed rate. This glass of water is a bit like a variable rate. They both have water in them. It's both interest. When we take a look at this one, it's got a cap, this one does not. So, essentially, the water in there is your interest. When we shake things up a little bit, as like what happened with the most recent turbulence in the markets, your interest stays the same. If I were to do the same with this, things would get a little bit messy. However, with variable rates, Bank of Canada meets once every 6 weeks, they can top it up. Or, in their wisdom, if they decide that rate needs to come down, down it comes. So fixed rates stay the same, variable rates change. And that will happen throughout the life of your mortgage. But how are they determined then? How does one know what rate you can get on a mortgage? To illustrate that, let's talk first about fixed rates and then about variable rates. This is a chart of the 5-year Government of Canada bond yield. Essentially, this is the last 3 months, and this is what an investor who buys a Government of Canada bond can expect as a yield. You'll notice that the rates vary quite drastically from one day to the next, but it's a pretty stable investment as investments go. This is the last 3 years. So the chart that we just saw goes from here to here. It's a bit of a roller coaster and a little bit of an oxymoron because this is fixed rates. Fixed rates go up and down very quickly. You'll notice 2009, this is where we had our financial crisis. Things came up a bit and then back down, and now we're on the rise again. So if you look here, you'll see that the trend for fixed rates is higher within the last, say, 6 months. It's got nowhere to go but up. It'll see a little bit of fluctuation up and down, but by and large, rates are rising and will continue to rise. This is a picture of the last 5 years of the same thing. So you'll notice 5 years ago rates were a lot higher. That's more like the average for a Government of Canada 5-year bond. Down here, we're still at very low levels. So anybody who's considering a fixed rate mortgage, you're better off thinking about it now than you are, say, a year or two from now. But why am I looking at bonds? What does the bond have to do with a fixed rate mortgage? Glad you asked. The thing is, with your mortgage, whenever you purchase a mortgage, whenever you get a mortgage, I should say, the bank who you get it through, or the lender, generally is selling it out the back door to another investor. And those investors look at a mortgage-backed security, which is what they purchase when they purchase a bunch of mortgages together. It's called a mortgage-backed security. They look at mortgage-backed securities and 5-year government bond rates as being about the same kind of risk. So as the bond yield goes up, they're more likely to take a bond than they would a mortgage-backed security if it were not priced competitively. So mortgage-backed securities tend to rise and fall with the 5-year government bond. However, in order to make a profit, the banks have to charge you a little bit of a premium. That premium is usually about 1.5% to 2%. So on top of the government bonds, you're paying a premium to the bank, and that's how they make their money. So essentially, if you wanted to know what's going on in the fixed rate world, all you've got to do is look up 5-year government bond and take a look at the chart. It's usually a couple of weeks out, and then you can see what's going to happen with the mortgage rates. That brings us to variable rates. Variable rates are set in a completely different way. The variable rate is set by the Bank of Canada, not by the government bond yield. Variable rates, on this chart, the variable rate is the beige shaded. The blue line is the bond, sorry, not the bond yield. The blue line is the average of what's been available for fixed rate mortgages over the past 5 years. Sorry, this is a 10-year chart. So starting here 10 years ago, you'll notice that the fixed rates, sorry, the variable rates, let's get that right, let's not confuse anyone. The variable rates step. They change in steps. That's because the Bank of Canada can only change the interest rate for variable rate mortgages, for variable rates, every 6 weeks or so. There's 8 times in a year when they meet, so it's roughly 6 weeks between the Bank of Canada meetings where they set them. You'll notice down here that we are presently at 3% interest on a prime rate. Going back, 3% over the last 10 years is still below average. So also with variable rates, there's nowhere to go but up. Variable rates are set by a number of different things. When the Bank of Canada sits down to decide what their monetary policy is going to be, they set what they call their prime lending rate. They set their target rate for the overnight lending. What that means is that that's the rate that banks lend money to each other at. They call it the key overnight lending rate. So if a bank can access money at 1%, which is the present rate, if they can access their money at 1%, they're going to lend it at 3%. 3% is the prime rate right now, giving them that spread so that they can make their money. What determines how they set their prime rate? They take a look at how the dollar is doing on the open market, at economic growth in Canada. They take a look at whether or not our major trading partners like the US are doing well. They take a look at imports and exports and inflation and try to bring it all together and say, this is what's best for the country, this is what we will do for an overnight lending rate moving forward. Inflation is a big thing you hear a lot talked about in regards to variable rate mortgages. The Bank of Canada's target interest rate is 2%. That's what they're trying to keep it at. As inflation goes up, so does the variable rate. As inflation goes down, so does the variable rate. They move together. More inflation is bad. Too much inflation is bad, I should say. Too little inflation is also bad. Deflation is bad. So it's a major balancing act. They're trying to figure out just what to do and how to move forward. So to recap, fixed rates are a lot more like a roller coaster if you look at the charts. They rise and fall almost daily. But when you have your fixed rate, it will remain the same throughout your term. Variable rates, on the other hand, the The charts look a little more stable, but they will rise and fall throughout your term. Fixed rates are set by bond yields. Variable rates are set by Bank of Canada decisions. I hope this has been helpful for you, helped you to understand a little bit more about the mortgage rate world. And if you still have any questions, please feel free to give me a call at 778-908-9832 or an email at pcarmen@mortgagealliance.com. And remember, regardless of the rate environment, a mortgage broker can help you understand how you can save money over the entire life of your mortgage and will work with you to help you do that. Have a great day.